Hi, this is Randy Finney with the right side of the chart, and today is Thursday, May 30th, 2024. It's 11:29 Eastern Time as I'm starting the video, so we're a couple hours in the trading day, and just wanted to do a follow-up. Got the post out to you. We hit that fifth and final target. That again, there's really two concurrent trades. You know, depending on how what your trading style is, if you took it, or how you trade. The active trader trade, that was from Thursday right there. Remember, that came on the heels of the bearish engulfing candle, which is just to the left of this 5-minute chart. And that was an entry mentioned for typical swing and trend traders. I'm just drawing it down. I'll show it to you on the 15-minute chart. So the active trade was short anywhere. We were right under that 930-ish level there, with an additional sell signal coming to break of the trend line. And so that's it. Again, active trader, it's 1.5%. It's not a big trade, but it's less than 2 full trading sessions. I got out to you late Friday. Mondays were closed yesterday. So if I said 2, maybe actually, what is that, 3? Yeah, we had all day, of course. We had all day Tuesday. Wednesday, I forgot I was away from one of those trading days, away from my desk. So that's it, guys. And the way this thing works here, this is called active trading. You've got the positive divergences on the 5-minute chart. You know me and my divergences. Just like you had one there, you took out the little trend line, you had to rally back up, as covered in the video yesterday. You would if you took it out. And as I said, it would provide an objective short entry on a pushback to resistance, which it did. And I continue to maintain these targets. That's why that was not the bounce spot. This one, I think, might have a little more legs because we have now, again, another divergent low, but it was also, you know, the reason I list final targets, that's usually where you tend to get a meaningful reversal. And so, as I mentioned in there, there's my bounce target right there. You can take a shot there, you know, right under today's lows as an active trader, and game a bounce up to the intersecting downtrend line that I added here today, because we have those, you know, nice, you know, distinct reactions now, 3 different points, and 18 little, you know, you want to sell a little shy of 18,729, and or the downtrend line, whichever comes in first, you know, if we zigzag there. So that's that. Let me show you a few other time frames. Let's skip out to the 15-minute chart. This is that. There's that. That was the day the bearish engulfing candle was set, and you get those when you have a big move up. You got to take out the previous day's a high to get a bearish engulfing, which you did. We're looking again. This is just a 15-minute chart here. Put in the bearish engulfing, and then so you know the Friday's short entry was actually, you know, what I talked about the bearish engulfing is if you're going to take it as a swing trader, trend trader, as I said on Thursday, you want to see as you're heading into the close. I said, you know, during the day, I said if this bearish engulfing sticks, and so the strategy is wait, you know, towards the end of the day, and when you see you're going to get the bearish engulfing, you can short there, or you can always wait to the following day, and most important, you just can't take out the top of it. So either way, one in the same trade. Now, again, this was decent support. It wasn't a random, you know, level I picked. So the way this works is 2 things. As I said in that post I got out to you this morning, if you're playing the long game, and look, we're just coming off that high. I can tell you right now, I reversed here at T5. I'm not going to get cute on this bounce, and I'm not going to get married to it. I'd like to see a rally up to that level. I will almost certainly be taking profits there. If I wasn't, sometimes what I'll do, if I thought there was look, you can get anything. Anything's possible. I'm going to be taking profits there. Sometimes I'll just, as you get close to a target, raise my stops to protect profits and let the position ride. I'll move up tight stops. But that's all I'm looking for. And then most likely reverse back short with stops somewhat above, or just take a starter position and kind of step back and assess. Now, there's a lot that goes into this, you know, and that's why I do these videos. I'm looking at this. I'm going to go over SPY, treasuries, everything else, and show you what's, you know, what I'm seeing. But that's it. So that was a 5-minute chart I started with, and the one I got out to you this morning. And you can see this is a 15-minute chart. Some of these lines bleed through. Don't ignore this. That's not it was divergence actually right here, but it was on that 5-minute I showed you. And so these lines just carried over into the 15-minute I flipped to. But now you have a pretty decent divergence here on that 15-minute time frame. And again, good support. Why is it good support? All these reactions, all these. That was a whipsaw, and that actually makes it more bullish. You went below it and then flew right back above it instantly, nearly instantly, and recovered it. And then boom, you had that run up to new highs there in the market. And then so this is really a big. This is the range right here now. Remember, we had a range back in February through early April, I think it was. Remember that range? We shorted break of 433. Well, we shorted the top of the range and we swung it down to T2. And now we have another range like that. The bottom of this range is more defined, better defined than the top, but there is a top there. That is pretty much, like I said, you can box tool it. I just circled it. And so this is TA 101. This is where, you grind it out. It's an active trader. You make your money and take book profits and turn around, short, go long if that's your thing. Let me look at a few more time frames just to kind of make sure we're covering all bases here. And sometimes as I'm doing these videos, I come across something like this. So this is where I flipped a setting the other day. I went out yesterday and bought a new laptop and loaded all my software on it. I was not happy when I was traveling. My old laptop works fine, but then some of the software, and it was a little slow. So so what I did, where I'm going with that, is when I configured this charting platform on there, I had toggled off some setting with the lines. Now my 60-minute chart's all mucked up, but I can turn off all the annotations. I'll clean it up, guys. It's got the annotations from all the time frames on there is what we're looking at here. So, but remember, bigger picture was this. You had that downtrend line. I said that was a hard line in the sand. There's that trading range from early in the year we talked about. We shorted that post-Fed high, wrote it down there. Also had a short entry on the break of the range. Right there is exactly when T2 was hit on QQQ. Remember, swing and trend traders, QQQ, my 60-minute charts and daily charts, those are the swing and trend trader time frames. When I'm posting these little 15-minute charts, if that's not your wheelhouse, I literally saw a thumbs down. Yesterday I posted we hit T3 on that 5-minute chart. Somebody thumbs down. I said we hit a price target. So someone's actually angry that we're profiting short. I don't get that. But again, ignore it. If you're not an active trader and you hate this short-term stuff, I've literally had those comments before. People almost seem to get angry. Guys, I run this, sir. I do what I do. First and foremost, I'm a professional trader. I've been doing that for years. Site is a sidekick hobby. I love it. I love trading. I love sharing what I see. And I'm going to post what I'm doing if I think others can make money. And I've had enough feedback from others that do the active trading thing. But where I'm going, this is a swing trading world. There's that other trading range I was talking about. And remember, back there, all long, reverse long off there, short down into T2. Reverse long gained the initial part of the bounce, started scaling back in short, but was very, very clear and repetitive on my trading plan. I would not add back above 1800 right there, which was comparable to 433 on QQQ. So that was my no-go trading zone. And then stop out if they took out the trend line, because I said if they took out the downtrend line with off the highs, that they would most likely quickly go up to new highs, and it did exactly that. So that's why stop out. So that was, for me, an old trade, and this was the new one. Started shorting again back here when we had, again, last week, put in the bearish, the divergent high, and then we had that active trader setup. And so that's all that. So again, this is messy here. Let me go to QQQ, and then I'll clean this chart up by the next video. You can see I had TLT up here. This goes into everything where we're probably going to bounce. Remember, TLT was also long here off the lows. It was both a pure play and or a hedge to any index shorts, because if TLT goes up, rates are going down, and the market will go up with it. Market rates, TLT goes down, rates are going higher, market will fall, and of course, nothing goes straight down or straight up. So we got rejected. We're expected at the downtrend line, major downtrend line right there off the highs. And it's really a price channel too, if you take this line here. Yeah, tried to test, boom. And when it was clear that the bulls couldn't get through there, the bond bulls, you got rejected pretty impulsively. That was that drop that we just covered it. In the fifth target right here, we hit today's low. Treasuries actually started moving up today, and that was another cue, is to get ready. So again, that's why I do these videos. That's why I'm not a one trick pony, or I don't watch one thing. I know some folks will only trade ES, and that's all they watch. If you take all this into consideration, and you see, bond yields were moving up today. Here, I'll show on ZB. CB is the 30-year. We were looking at TLT. It's the 30-year bond ETF. CB is the 30-year bond fund. And so there was the yield started ticking up today. It's most likely reflects a bounce. Anyway, so that was, if yields can, I'm sorry, yields continuing lower. When bonds are going up, remember yields are going lower, and that's going to be net bullish for the stock market. So this happened first. And so, had you seen, yields continuing to go down, and we did this, and look, we could do it today, guys. We could turn around and do that. But if we go down, remember how my mind is wired. My trading plan. This is a trading plan, a bigger picture, a swing and trend trader trading plan I've laid out for you months ago, and I continue to live by it personally, and I continue to bring this up, and that is trading with these zones and watching bonds, because all you turn on bubble TV, CNBC, Bloomberg, you're going to hear the same. That's all they're talking about. What's Powell going to do? What are the rate cuts? Chance of the rate cut? They've been cheering bad economic news. The economic indicators are really finally starting to turn. There's a pretty clear trend that they're turning. It's nothing horrible yet, but it's a turn. I'm talking about employment numbers and manufacturing and a lot of other things. Again, it's still here and there, mixed bag. It's not a crystal clear trend. It hasn't been a big move, but there has been a clear trend that every time we get a weak economic report, the market some rallies because they think that a Fed cut is going to be more important than will override a recession. And I give you my word, when if the turn comes, and I think the turn's coming, meaning unemployment starts going up, which means that then consumer cuts back in spending, which again, that's showing they've already done. It's insanity, but it's here's the thing, it's not. I've done this long enough. It's every single economic expansion and contraction, i.e. recession. It's the same story, and you watch, and the last pillar to always go in those is the employment, the jobs data, the jobs market. Earnings are peak, earnings are high, everything's hunky-dory, but when the job market turns, then the recession's inevitable, and then the stock market will ultimately follow. Okay, let's not get ahead of ourselves. I just wanted to say, I know I got a little on a tangent, but again, the market's been cheering, for the most part, bad economic news and reports, and actually going down on strong reports or sometimes non-event. So this is it. So you can see these are lines that were here. It's not a random event that TLT bounced there. That's a line I've had here for many, many months, all the way back from October of 2023. So support, initial tag is support from above. You're likely to get a reaction, and that's it. Where to? Well, let's look at that. All right, so I have a downtrend line. It's a potential target I gave you on the 5-minute chart of NQ, and you have something similar here, a downtrend line on Treasury bonds, and a resistance level there. And then, like I said, if you are a swing trader, trend trader, and you're looking to, maybe you took profits today at that active trader target, you're an active swing trader. I use all those labels. I'm that too. And you're looking to re-enter, well, you can, ideally it's great if you can re-enter at a better, higher price, but sometimes you don't get that. So maybe you're saying, okay, what, Randy, I'm going to wait till we bounce up there. Or you're a bull. We've got a couple of them on the site, and God bless you. It's been a great year to be a bull. If you are buying all these dips and you're buying the breakouts, by all means. But if you take out that level and you start to enter the yellow zone, which is right here, it's not very big. Then the green zone, all the better. However, if we don't get up there and we start to do this, and we turn around, we're flirting with. We got close to the bottom of my orange zone, and again, that now kind of establishes the reaction low. Which again, this reaction low in IEF, the 10-year bond, is also the recent peak in Treasury yields. So watch these lows, watch them on IEF, watch them on TLT, and the market will become increasingly sensitive. So there it is. So that's what we're looking at here, guys. And I wanted to once again say that, those are potential bounce targets. But when I look at what's happened recently, with those a lot of bearish engulfing candles. I covered it last week. It wasn't just the indexes. We had quite a few stocks. In fact, one of them I got an alert on today. It's right on the line, but that's KLC. That was one of the ones that put in a bearish engulfing candle last Thursday and has this beautiful uptrend line, bearish rising wedge, big divergences here on the daily chart. This is one of the big chip equipment makers. The semis themselves, really it's one semi that's been holding the group up for the most part. There's XSD, one of several semi ETFs. Big divergence. It had it ever so slightly pop above the bearish engulfing candle. Again, indexes I put a higher weighting on in the majority of stocks, but you have a similar uptrend line right there. You can, yeah, I'll pull it right here. I'm going to put the trend line. That's the best fit. Why is that the best fit? Well, I'm tightening it up is what I'm doing. I zoom in and I'm right at the bottom of that candle, right at the bottom of that candle, come in the body of that candle, and we're right there. Again, if you have to squint, it's not a breakdown, or you want to give it the benefit of the doubt. But to me, it's a breakdown that looks inevitable. So yes, that means very much still a short. This is SOXX. Mentioned back here is a short on that bearish engulfing candle right there. All we've done is made a virtually an equal high, and technically went above it. But again, we have those bearish engulfings in the indexes. We have them on quite a few big stocks, and as I said, I take this all collectively, not just binary all or none. Well, that one popped it, but you also on stocks besides the big divergent high, and this was again that was a divergent high. We did trade it. We went down. We hit T2 right there. T1 was hit here. I might have added some lines. That was T1 back there. Hit T2. I think T2 was here. It could have been that one if it was hit. Sometimes I don't update all of these and look at the charts. Either way, close enough. If not, right? Reverse and basically an equal high. And so where we had divergence over there, a divergent high back in earlier this year, and that was followed by a drop of 16%. The only thing different now, technically, and again, this is me being as unbiased as I can, the only thing that I see different in this chart now is the divergence is much bigger, indicating the potential for much larger drop. Just like the Qs and S&P 500, I think at minimum they're going to come down and test their 200 days soon. That's going to put it from where we're at right now. If the 200 exponential, I'm just going to split the difference. I'm going to come down to this target here, and that's going to be about an 18% drop. Probably wouldn't surprise me. I'm still maintaining T4 down here. This T4, T3. I'm going to have that T2 right there. So there's your targets, guys. And I added this level here. I'm going to round it off. It says 201.99. Let's just make that 202 as an even number. And so, and that's it. So I zoom in nice and tight here. Let's tighten up that uptrend line. Well, I just messed up that 200 level. One thing it's too easy to move the lines here on these guys. So let's get back to 200. There it is. I'm trying to move this trend line. I can grab it up here. And then what I'm doing is I'm tightening it up. And got to get that little circle there up top so I can move it. There it is. No matter how I put it, we're below that one. And that one's not so much of a squint. It was a squint yesterday. Today we're down below there. So although we just hit support on QQQ, keep that in mind. It is a thing. This is a breakdown in the semis. You could make a case. It's certainly making a case for an objective short here, or you want to play it safe, wait for the Qs and SPY to take out today's lows, or bounce back to resistance. And if they do, what's going to happen here? Well, semis are going to do this. Back test the trend line and give you a short entry at a higher price. You've got a little island, a potential island top right there. That island top is a candle at an end of an extended uptrend, which is safe to say this is. That's technically a new high in SOX, separated by gaps on both sides. So a lot like the bearish engulfing candle strategy, it's a very, very simple and phenomenally favorable kind of setup. What I mean by that, the RR is very favorable because a island top in candlestick, just like an island bottom, is a a trend reversal. It's a bottoming or topping stick. In this case, it's a top. If you have a, after a long downtrend, something's been in a downtrend for a long time, and then you see a gap down and then a gap up the next day, and you have that candle or cluster of candles is separated by gaps on both sides. That's an island cluster bottom. The island cluster top has gaps on both sides, and the strategy is super simple as well. If you want to play it safe, well, you have to wait till the gap down the next day or you don't have it. Just a random gap is a gap. You get them all the time. So now you saw yesterday a gap down. And look, we're still there. So I'm not giving you dated information. We're still trading where we were yesterday. You take a short position and your stop is right there. You can say if they backfill the gap's there on the top of the body right there, the candle, or no, the top, it's a green candle. So the gap is, it closed up there that day at 240, 250-ish, whatever that shows you right there. But, like I said, give it a little room, and then, so what is that? Let's just talk numbers. So you're going to give it a stop a little over the high, 3% stop loss for, if we go down, let's just say we only go to T2, right? Oops, didn't mean to do that. We'll go down to T2. You're going to get 17%, risking 3% to make 17. Take it all day long. Is it a counter trend trade? Have the semis been in a strong bull trend? Yeah. But in my opinion, what will offset that, the probability of it playing out, again, so I said these are, these island cluster or island tops are potential reversal patterns. And again, you can get gaps. You get gaps all the time in an uptrend, especially in a volatile security like the semis. So let's just say your odds aren't great. Let's say they're below 50%. Well, Randy, why would I take something if I have a less than coin toss odds to play it out? Because again, that phenomenal RR, the above average risk return ratio, in my opinion, more than offsets it. That's why you can take those shots when you see them and they look legit, and there's other evidence. Everything I've been talking about in these videos for a while and QQQ. And again, so we just power on up to new highs. Oh yeah, there'll be some hecklers on the site, but guess what? If you take this shot, you've lost 3%. You lost less than that. What did I on SPY and QQQ last week? What did I say, 2% over those bearish engulfing candles? Even if you give it a little room, maybe 3%. So you lose 2 or 3% again to target if you're going to hold tight, and and if you have a trading plan, you're going to stick to that plan, which says as long as I'm not stopped out, I'm going to do that. Now, swing trader, trend trader, you got to decide if you want to game the counter trend bounces. Sometimes it works out great. Sometimes when you try to do it, and you book profits at some of those earlier targets. And then you never get back in. It doesn't let you in. Let's just say you go, it starts to bounce, you reversed, you went long, and then a big gap down the next day, a gap that you don't want to chase because it's too big. So you're waiting for a kickback rally that just never comes. That's how these things will often play out. You can just go back to any point in time when you get those corrections. And it's like here, nobody wanted to short there on the divergent high. In the rally, they wanted to buy the dips. And they said, oh, that's sort of. But then when it started to become clear there was a downtrend, seeing lower lows, right, and lower highs, that's where the selling started to accelerate. That was a pretty swift move down. You had another rally. If you didn't have a lot of time to think about it or to get back in, and then the selling got even more impulsively. That's how corrections work. They're super profitable, and that's why I do it. That's why I love shorting. Stocks tend to fall faster than they rise. And again, if you don't believe me, pull any chart in history, go back, measure a bear market, 70% drop in the semis right there, which wiped out gains even to the left of that chart. You can't even do it here. We'll do it on QQQ for you. Again, this is basic stuff, but I know some of you are new to this. I go over this stuff. Bear market in 07, 09. In just about a year, the market lost about 55%, both the S&P and NASDAQ 100. And that 1 year right there, roughly, when it was really the S&P peaked here in March, so made it a 1.4 year bear market. But the NASDAQ 100 actually peaked bottomed in November, so it was just about a year. So in 1 year, the NASDAQ 100 wiped out, as you can see in my little the date, over 6 years of gains. 6 years of hard-earned gains were wiped out in just 1 year. Okay, that was an anomaly? No. Same thing happened in that bear market. NASDAQ fell 82% and it wiped out. You got to go back all the way here. 5.5 years of gains. Okay, what happened in COVID? In just 6 weeks, you wiped out right here. All these gains. You were at the same place you were back in 2.5 years earlier in the NASDAQ. All those gains leading up to that point. This 2021 to 2023, 2022, I'm sorry, yeah, 2021 to late 2022 drop, about 11 months, 1 year. You can see that, and we wiped out at that point all these gains back, going back 2.5 years. So anyway, so that's that. And again, you just, the key with the shorting is you don't want to be the last guy or gal to leave the party, or a game of musical chairs. You don't want to be caught standing when there's without a chair when the music stops. So, and that's why I do these constant updates. And if you listen to each and every one, I do my best to give you foresight analysis, not hindsight. I'm giving you the levels to watch ahead of time, the levels that, if broken, there's one, this is also why we hit support. This is a 60-minute chart. I'm bouncing all over the place, guys. I'm back on QQQ. It's the same level I just showed you, so it's support there. But again, we're coming off pretty powerful stuff technically. And the only way I can describe sentiment, I haven't pulled, I'll pull them up in a second. I can pull the sentiment polls, put to call ratios, all that, but you can just turn on the TV, and not just the TV. Unless you live in a bubble, I'm talking to people that don't even usually, aren't that into the market, and everybody's talking about how NVIDIA, how somebody told them to buy NVIDIA, or they want to buy NVIDIA now. The folks on TV when NVIDIA reported, and just not just NVIDIA. Their point is, since NVIDIA is going, AI is here to stay. It's going to change the world. The only time I remember such bullishness is really going back to the dot-com bubble in 2000. This is the closest thing. Traded through all those markets, including the top in 2007. There was some animal spirits burning pretty hot there, but nothing like now, or nothing like back in 1999, leading up to the pop when the NASDAQ popped in March of 2000. So where am I going with all that is, again, at this point in time, I wouldn't be surprised to see these counter trend bounces get sold into on the earlier part. So that's why where normally you get even 15 minutes, 15-minute chart. We don't have the divergence here on QQQ 15. We definitely don't have it on the 60, but we had it on the 15-minute chart of the futures NQ. Let me go back to that. And so where I'm going with that is normally 15-minute positive divergence. You can see it here, positive aka bullish divergence on the 15-minute chart, which is what this is. Price is making a lower low into T5. Let me use my line tool here. That's our divergence line. There's the indicators making the higher highs. Normally, that's the catalyst for the road to new highs. And I'm going to say this, and I'm not saying it in a type of facetious way. There are some of you that are very bullish on the site, believe this market's going to go up for a long time, going to keep going to new highs, at least in the foreseeable future. If you're not buying here, when do you buy? This is a level this is the best support level I've seen, the best buying up, or the best support level. Let me use my words carefully. Very, very well defined, and positive divergence here on the 15-minute chart. Again, we had a little divergence there, and we got a bounce. It's not that it's if we didn't get a bounce, it was a tradable bounce. But this is even bigger divergence, and that bounce was only at minor support. This is at much better support. But then on the flip side, we've taken out things such as this trend line here. Again, I got to fix my 60-minute chart. We have a big bearish engulfing candle on the daily right here. We had huge negative divergence that's been building. So that's why. So this to me, I think, is the most probable scenario, guys. We'll come up. If we get a rally, and it's not a whole lot, but it's, get close to that trend line, that's probably it. If, and this is where there's that if. Like I said, if you're looking to game a bounce to get short or add to a short, or, re-enter if you covered here, you may or may not get it. And, it could blast on through there. And it works this way too. If you're going to short at that downtrend line, you want to keep your stops tight, you're pretty risk adverse, have them a little bit over that, maybe on a 60-minute close. And then if that gets taken out, all those targets I gave you in reverse, this is how it works. Support once broken becomes resistance. So you have all the levels. They haven't changed. Sometimes I'll tweak them. This was T2 back here. It was hit, brief punch through there. We rallied. Remember, we took out that downtrend line yesterday as I was covering. Now that became those highs, which was also price resistance, then became this downtrend line. And so, again, these are your targets. Price resistance, 18,730, which was our T3, was support. Went through it on what I call, and this is a great example too, guys. I know I'm just going over everything. I haven't brought this one up in a while. If you followed me for some time, you've heard me say this hundreds of times in the past. I make up a lot of terms, and this one I call a momentum-fueled overshoot. And that is when, see, this is the nature of a correction. Remember, we kind of zigzagged down, had a nice counter trend rally. So we can call it ABC correction, maybe, if that's all we're going to get. But see how the selling really began to accelerate once it was clear after that breakout. We had a divergent low. This is where a change of character in the market. And I told you I expected that if we took that trend line, it would be a shorting op, not a buy signal to go to new highs, that you could short resistance yesterday. And that's exactly what you got. And the fact that we had positive divergence here on this 5-minute chart, and it only led to that. That's relatively small bounce, and it didn't lead to new highs as it often has for the last couple of months. That was a change of character, and that's, I think, why you got that impulsive move down after, because for the dip buyers, it was one of those WTF moments, like, wait a minute, we're supposed to do this, and so I bought the breakout of the trend line. We only went here, and so then boom, all their stops get hit, they get out. Anyway, that's the momentum fueled overshoot, is when you have a security either going up very strong, very impulsively, nearly vertical, or down very strong. You tend to overshoot the actual support level that would have held. And I use the analogy of the pitcher's glove, throwing a 90+ mile an hour fastball. Pitcher throws the catcher's glove. It hits the catcher's glove. The glove's going to snap back. Catcher's wrist will snap back from all the force of the ball hitting, momentum, and then it'll come back forward. That's the same thing. So you overshot it, and then look where you ended on the kickback, right to it. And that's a momentum fueled overshoot. But then support once broken, you went to it, couldn't get through it, and then boom, went down, hit T4. If you look closely, there was certainly a reaction there. It wasn't very big. It was a minor consolidation. Shot through there, and this is the future. A lot of this overnight stuff, you get these moves, and that's it. So that's where we're at now. There's T5. There's that first target, the first resistance level. We could have gamed a bounce. I still think we're going to get a little more from this. And as always, I'll continue to update. Alrighty, that's a lot on NQ. It is my preferred trading index, but the other one I like too, and I do trade and have positions on, is RTY. I told you yesterday RTY would likely bounce because it hit a very good support level. It had positive divergence on the PPO, almost. That's what I call an ADL, almost divergent low, virtually equal lows, ever so slightly on the RSI. There's your divergence line, and that's it. So I would have been surprised. Plus, remember, Treasury bonds just rallied, so that added to the rally in the small caps today. RTY, of course, this is the futures of the Russell 2000. So that's the same thing as if you're an ETF trader. IWM. And so it's not mere coincidence you had a nice little oversold bounce in treasury bonds, and small caps are rallying because they are the most rate sensitive. They are very dependent on borrowing money, continually borrowing to finance ongoing operations, or smaller unestablished companies. Microsoft, Apple doesn't need to borrow a penny, but they do. They sell bonds, or they did, in recent years, because the Fed gave them an environment where they could borrow at virtually zero, super low rates, 2%, 3%, whatever their bonds were. And so they took that money, turned around, borrowed billions of dollars in bonds, sold bonds to the public and institutions, took the money and used it to buy back their stock and juice up their stock. And so my point being that if interest rates went to 20% tomorrow, Apple would stop. They wouldn't be issuing bonds, but they don't need to because they have enough revenue from ongoing operations, cash flow. Small caps don't. That's why you see this hypersensitivity, especially now, and more so than in recent years, in this hypersensitive inflationary environment where everybody's hanging on every single word of the Fed, any Fed member, especially Powell, and of course the economic data. So there it is. But again, that's fundamental. But the fundamentals do go with the technicals. So again, if you're trading the indexes, especially if you're trading the small caps and you're not watching bonds and bonds break out or break down, that's going to determine, it's going to change the direction of the small caps. So you want to keep an eye on both. And same thing, small caps, if the bonds continue to rally up to the trend lines I showed you earlier, guess where IWM is going, or RTY. Yep, you got it. So a little more upside. And remember, we're also coming off a divergent high there. And we've been so far stair-stepping lower. This is just a 60-minute chart. Let me not forget my ETF traders. That's what it looks like on the 60-minute chart. Divergent high, divergent low, right? Pretty simple stuff. Divergent high, drop, divergent low, rally, divergent high, drop. Is that drop over? Probably not. That's my opinion. But it has a little more upside in the near term. So that's me defining time frames, because I know it sometimes confuses people. Well, Randy, you said you're bullish on XYZ, but you just said you're short it. Well, I'm short it for today, maybe tomorrow, and then I'm going to be back long again. That's the whole active trading thing. That's what we're doing. You know, if this was investing, and I'd tell you to put all your money in an S&P. If you have a 10, 20-year horizon, well, even 10, I wouldn't tell you, me personally. 10-year, I think we're probably looking at negative returns on the S&P, but or close to it. But anyway, long term, yeah, buy an index fund and save your time. Go out and golf or do whatever you enjoy. But if you're an active trader, this is where we make our money, no matter what the trend is. We don't always get it right. Don't get me wrong. I'm not trying to say that we're constantly making money, that we're in at every divergent high and out at every divergent low, but a lot of them. That's it. So right now, there it is. Positive divergence here, and that has the potential to carry IWM higher for sure. The last time we had positive divergence on the 60 was right there. The time before it was right there. And this divergent low gave us that until we put in that divergent high. It gave us that, but that was a big divergent low back then, and it carried us up all the way up here. So that was just a corrective wave within there. And so there's kind of a bigger picture. And then the biggest picture of IWM is this. This is, or we can even go to the monthly. It's even more clear. Major top back here when the small caps peaked back in 2021. We had a very clear, well-defined trading range with a breakout to new highs, a marginal new high, but yet divergent high. It was divergent on the daily, weekly, even this monthly. That breakout failed. We entered this trading range, which we're at the top of now. So it's this simple. If you were a long-term investor, or a long-term swing or trend trader, you have two plays to make right now, or well, one play, and that's the short. Or wait, if you're bullish, for a solid break, especially it's a monthly chart. You need to see a solid monthly close above 210, but that will be a breakout. In my opinion, well, no, you're not going to have different. If we break out, I'm going to tell you right now, because I'll revisit this if it happens. It's going to be a while. It'll take a while to work out. This is a monthly chart. If we were to break out, it would probably send the small caps to new highs. And if it did, we're going to have the biggest divergence. The last time we had negative divergence was right there. Again, we got a big, healthy double-digit correction, bear market, whatever you want to call it. The time before that was COVID. Again, COVID was not a random event, at least not technically. It was forecast, price in, and that was our other previous divergent high, as was that one. These are all the biggest corrections. They're all, you can call it a bear market if you want. They were all double-digit, 20% plus drops, but that's an antiquated definition. To me, they were corrections within a larger secular bull market, or they were cyclical bears within a large secular bull, blah, blah, blah. It's all, again, semantics, however you want to define it. But. So we break out any new high. All I can guarantee you, I can guarantee. I can't guarantee where it's going to go or how it's going to play out, but I can guarantee if it happens, and it takes just, a few months, 3, 4, 5 months, to go to new highs. If it happens anytime soon, it will be a divergent high with clear negative divergence and overbought conditions, because the RSI is going to come up, which will greatly increase the odds that it fails. So it would be a new high. They'll be cheering it in the small caps. And look, it may or may not happen, but for it to happen, first we have to take out 210. We have to take out the top of this trading range. And then that will be the analysis I'll be talking about for a while. And if, it might be worth gaming it, picking up nickels in front of a steamroller. It's probably a healthy double-digit move. I'll measure it for you here. It could be 20% easy, and that's about roughly what it would be, give or take. But it hasn't happened yet. As of now, that is a divergent high, and that may or may not mark the top. Same thing, in the NASDAQ and everything else. You look at QQQ. We didn't have divergence on both indicators there. This is the divergence now we have on the QQQ and SPY on this monthly time frame. That is a divergent high. And when do we get a pretty powerful long-term sell signal? On the break of this uptrend line right here. All right, right there. All right. I've covered the indexes quite a bit. I'm almost to the 40-minute mark. So if I roll into commodities and gold, precious metal, and GDX, all that now, it's just going to be a super long video. Let's cap this one here. You have the levels to watch. Kind of have my thoughts. Like I said, I'm a skeptically bullish, if that's a term I think I can use right now for QQQ. Seeing if we can just get a counter trend bounce. But I'm driving with one foot on the gas and one on the brake. Like I said, for the reasons I said earlier, I would not be surprised if this thing, just as it starts to get going, fails. But and if so, then I'll flip back in to shorts, or at least pull out the long, sit tight and wait. If that would be at minimum, pull out and then just wait for a break of the lows, or something that I see that gives me confidence. It could be something in treasuries. It could be a key stock breaking down. I'd love to do that in the next video. This one got kind of long. Go over everything, these market leading things. Let's not forget about that. I used to do that on a near daily basis or a couple times a week. Big, remember Microsoft, the biggest of all, bigger than Apple now. The only 3 trillion plus company is 3.2 trillion. Divergent high and bearish engulfing candle break, and I'm sorry to stand corrected. I think I have to add up Alphabet here. I'll show you how I get those numbers right here. Microsoft 3.2 trillion. Okay, sorry, had to pause it there. I had somebody at the door. All right, so yeah, divergent high, big divergence. Again, we had a divergent high there. It was, again, a double-digit correction. It helped us swing QQQ down to T2, where we hit and bounced as expected at that time. And the only thing that's changed is an ever so slightly marginal, but still divergence. The divergence that was in place has only been extended, so it's not a new divergent high. It's the same divergence, even bigger, and a beautiful bearish engulfing candle, and also a break of the trend line. So it's like check, check, check for me. Now look, we just hit support. This is where Microsoft bulls will most likely and almost certainly come in. It's a very good support level. You can see my purple box here was a trading range. It was the top of the range. We broke out. We had this sideways range, but that breakout didn't hold because it was a divergent high, and with overbought conditions, it failed. But then we powered on through there, went up, made a marginal new and still divergent high. Why did I put so much focus on these bearish engulfing candles? Well, let's just roll back and look at the last time Microsoft had a bear market and peaked. That was in 2021, right here. I'm going to turn off all the lines. I'm going to zoom in for you real quick, and we'll look at the other things. So we go all the way here. We look at this. And there it is, guys. That is what you call a bearish engulfing candlestick. That marked the top. If you shorted that one, and I probably would have mentioned it at the time, you can go back on the site. I can't remember if I caught on Microsoft. I probably caught them on the indexes. We were short for other reasons too. Trendline breaks at the time and divergences, and swung that, traded that last bear market like a champ all the way down. There it is. So you would have shorted it there, and I just wanted to give you how far the stock dropped. And so that is a trend change, a primary trend change. It came after an extended bull run, and from top to bottom, Microsoft, which is now the world's largest company by market cap. I'll have to add up the 2 Google share classes. I think that's what I was doing when my doorbell rang. 39%. You'd have wiped out. If you had 100 grand in the stock, you would have been down $40,000. And most likely capitulated somewhere in there if you were holding it. Anyway, so what happened back? Let's even go a little farther. I'm just trying to show you this is what technical analysis is all about by its essence. Oh, that was almost a bearish engulfing. It was ever so slightly above that previous one. That was right before COVID. and then it dropped 31%. But so that was the last that one there that I showed you. And again, there were plenty others, and so that's where we're at today. And so back then, I know because we were doing the same thing we're doing today. I was on the site. We had the same subscribers. CNBC would turn on from time to time and hear what they're saying and read the, all the news feeds, and everybody was bullish and the market was going to continue to go up. And then one day it just stopped going up. And then I'll talk about these technicals on CNBC. I guess they have more technicians now. When I started in the business back in the 90s, and CNBC was just getting going, even before I was in the business, they used to mock technical analysis. I remember that if anybody came on or tried to say how they could predict where prices were going, looking at the charts, it was crazy. It was witchcraft, voodoo. So that's it. So anyway, key leading stocks going to have an impact on the index. One sell signal there with the bearish engulfing and the follow through candles. Second sell signal on the break of the uptrend line. Now we're at support. Also the 50-day moving average, that yellow line just below. So pretty much whether we get a reaction here or not, I do favor one. A break pretty much of today's lows, assuming the QQQ and SPY and the majority of those other stocks I'm about to go through also do that. That will be your next sell signal. And I don't have really anything I can tell you. It'll probably hiccup along the way right here about 409, but that should probably take us down pretty quickly at 397. Remember, that was a big level I had back then. This was a pre-earnings, a whipsaw that happened around either their earnings or another company's earnings. So take it with a grain of salt. That's why you got the whipsaw. And the fact that we went below and then back up is what gave us that thrust, all that short covering that took us to new highs. So when 397 goes, should be a quick ride down to the 200-day moving averages just below there. Apple, 2.9 trillion. Trendline break, I'm not super crazy about the trend line because I've had this violation back here, but yet it was impulsive when we took it out. We can, at this point, I add a BOD or benefit of the doubt trend line. Let's see if I can. If I wanted to. I don't want to force that one. I'm going to take that off. Just leave it where it's at. Bearish PPO crossover just occurred, by the way. High-level bearish PPO crossover. Last one we had, I'm talking, this is right here. I can see the lines have crossed. If you put up a histogram, you would see it. Go all the way back here. The last time we had a high-level bearish PPO, we flirted a while. We had one there, but then it went above. We were in a trading range, but we finally, the clear separation that the bearish crossover was in play came right after the top there. And that followed. We never saw those highs again till we bottomed all the way down here with that positive bullish divergent low that was pointed out at major support, that purple support level. Back then I said Apple and Tesla were the two best looking of the former Mag 7 stocks, and I think they both, if I'm not mistaken, had the biggest rallies, maybe other than NVIDIA. All right, and speaking of NVIDIA, he's up next. It's up next. Nothing's, the divergence still in place, divergent high. This will be the last to buckle. I said it before, I'll say it again. The market will not drop until the last of the fangs, real big, healthy correction till the last of the big Mag 7. And this is it. So we've gone down to the Mag 1 is what I call it. Alphabet, again, there's two share classes. That's what I was saying earlier. 2.2 trillion, and then down here, 714.5 billion. So yeah, it's close. They're all Microsoft, Apple, Alphabet, NVIDIA. They're all very close to that $3 trillion mark. Divergent high. There's your uptrend line. Needs a break. That's all. Amazon peaked on that divergent high so far. Got a little downtrend line, which could trigger a pop if it breaks out. It's also at support. However, if it breaks that support, which are the recent lows about 17.29, I've had that line there since mid-April. You can see on the pop-up box. That would be bearish, and upside break would be bullish unless it failed. Upside break of the trend line. Meta is just grinding on this 476.69. Remember, that's the bottom of this trading range right here. You had that earnings breakdown. It was in a trading range with a divergent high. Got smacked down on earnings. The rest of the Mag 7 were going up, and that's tremendous pressure. It's very hard. Tesla kind of was an outlier, how much it's fallen, being that it used to be in that elite club. Usually its inflows will bring it in. So, with the market holding up and going to new highs since, it gave a kickback rally, but Meta's still well off the highs. Bottom line, it's at resistance. This is called about 478. You can see there, and it just keeps. I'm going to move the line up, guys, just right now, and for a better fit to the recent highs, about 480. And again, it's still the bottom of that range, resistance. So it works this way. There are no guarantees, but a breakout above it's bullish unless it fails, and a breakdown below. Yeah, I'll still say, because that's that was support there. Obviously, you really want to see it break, to open the door for a much bigger drop over the pre-earnings low right there. That's about it. I'm going to stop it there. I could go over all the components of the NASDAQ 100, and that's probably what I'll do after this video. I want to check, other areas in the NASDAQ and in other sectors as well. But right now, like I said, we just hit support. I'm long and strong, in the active trading account, for the reasons I said, to try to game a balance. I'll keep an eye on treasuries, and then they're all going to come up to those, should hopefully hit those same downtrend lines around the same time, and then can reverse back short, be it for either an active trade and quick pullback trade, or probably a recycle back in. I'll just see how things look at the time, and I'll most certainly get some charts and or video out to you around that time as well. This has been Randy Finney with Right Side of the Chart. Have a great day.